Blog Talk Radio.
Welcome to Business Credit Radio. We're on blogtalkradio.com. Thank you for joining us. We look forward to a great conversation today. Business Credit Radio is the voice for credit and collection professionals worldwide. Our co-host for today's show is Mr. Tony Gaeta. From sunny, well, I don't know if it's sunny or not, but it is beautiful, Denver, Colorado. And my name is Philip Philbin. I'll be your host for Business Credit Radio today. Say hello, Tony.
Yeah, you were right, Phil. Very sunny out here today. The temperature's been in the 90s for the past couple of days. I'm enjoying it, but as I was saying, it kind of cuts into the Gulf a little bit. But that's okay. We'll get a chance to get out there and play. I'll tear up the course a little bit.
Yeah, it's a little bit sunny here in Chicago, too. Finally got a little break from the rain that we've been doused with for the last several days. So, if you see me floating by, just wave. Business Credit Radio is indeed honored to welcome back Mr. Jerry Bailey as our current guest speaker. Mr. Bailey is currently the Executive Sales and Education Service Manager for NCS and has been with the company since 1995. Prior to coming to NCS, Jerry was a corporate credit manager in the manufacturing industry for 10 years, during which time he gained a very thorough hands-on experience with both UCC filings and mechanics lien filings. Jerry consults with companies daily and has spoken to groups nationwide about Article 9 of the Uniform Commercial Code, the revised Article 9 Model Act, the nuances of construction credit, and the benefits of selling through secured transactions. His presentations cover not only the legal protections brought about by the mechanics lien and UCC filing processes, but also practical solutions of how and when to use these tools. Since 1970, NCS has been the leader throughout the United States and Canada in collections and mechanics liens, bond claim, and UCC filings. They offer proactive solutions to secure your receivables, minimize credit risk, and improve profitability. Today's program we've entitled Minimizing Risk in the Construction Industry. Welcome back, Jerry.
Hey, thanks, Phil. Thanks, Tony, and thanks for having me back. I truly appreciate it.
Looking forward to a show.
All right. So am I. Let's hope I can provide it. All right, folks. Thank you for those of you listening in. If any of you have sat in on the previous shows that I was on, we're kind of continuing on an odyssey or a journey or a path or whatever you like of collateral and credit lines. And that's really kind of what we're focusing on is the ability of trade creditors to take some sort of collateral against the credit lines that they extend. It's a concept that banks do very well and very consistently, maybe not as much for the trade credit area. We talked about UCCs last time. We're going to move over and talk about mechanics liens this time. UCCs are a little different. When we talked about UCCs, we were talking about instances where the collateral a creditor would get pledged against their credit line would be the personal property of the debtor, their assets, their inventory, their accounts receivable, proceeds they get for selling the inventory, equipment, mortgages, chattel, all of that. That's what we talked about previously. We're going to talk about mechanics liens today. Mechanics liens are a little different. The securities are different. The collateral is different. With UCCs, when we talked about them, they were consensual security. That means that the customer has to grant you this secured interest. They had to sign a document that granted you the interest in whatever collateral you listed. So it was consensual security, and there's an element there of we have to present this to the customer. Are they going to accept it? We don't have that with mechanics liens. Mechanics liens are not consensual security. We don't need our customer's approval to do this. All we really need to do is make sure we adhere to whatever steps are outlined to file a lien against the piece of property that we've improved. Now, there are some qualifications that we need to be able to file a mechanics lien. Not just anyone can file a mechanics lien. The right to own property in our country is a very protected right. Our government doesn't want just anybody coming in, filing liens against property and forcing you to sell property unless they ultimately have that right. So the theory here is very simple. You have improved a piece of property. The owner should not retain the benefit of that improvement unless they pay for it. And if they do not, then you have the opportunity to take security or collateral against that piece of property to whatever extent you have improved that piece of property. And that's the other difference is the collateral. The collateral here is the property. We have the opportunity to go file a lien, an encumbrance against this piece of property to whatever extent we've improved it. Now, obviously, that there's qualifications. The first one being the biggest one. We need to contribute to the permanent improvement of that piece of property. So if they're building a new building, we need to contribute to that. If they're refurbishing existing ones, somehow we need to contribute to that. That means generally if we're providing some sort of a tangible good, it has to be permanently incorporated into the property, like concrete or steel or windows or paint or carpeting or whatever. If we're providing conference room furniture, let's say, that we can walk in and pick up and take out, that doesn't really qualify as a permanent improvement to that piece of property. So that's the biggest thing we have to be aware of. Now, as we talk about mechanics liens, these are state laws, so they're very specific to each state. And unfortunately, any of you listening that are selling in multiple states in this construction industry, you understand just how diverse these rules and these laws are. There's really no continuity whatsoever from one state to the next with respect to mechanics lien laws. So the things that I understand that I need to do to file a lien in Ohio do me absolutely no good in Pennsylvania. And it seems to be that that's the way that it is. When we talked about UCCs, there's some reform there and some change that's trying to make it truly more uniform. I don't see anything like that in the mechanics lien side. On the mechanics lien side, the states make changes to the laws, but they're kind of driven by whichever group has the stronger lobbying body. If it's subcontractors, they like to try and make it easier, more uniform. The general contractors, title companies, they kind of like it difficult. They don't want it to be easy for people to file liens against properties. So those are kind of some of the differences. In the construction industry, it's very common practice for people to take advantage of the lien rights and protect their mechanics lien rights. It is just something that's done. Construction credit is very, very different than, let's say, normal credit.
I have a question for you. Oh, I'm sorry.
Certainly.
Me too. The question being this: if you file a mechanics lien, someone goes in, they're having a house built, or the house is built, they're changing their kitchen, and they put a $35,000 kitchen in, wood cabinets, et cetera, et cetera. Mechanics lien is filed. In the eventuality of non-payment, it's my understanding you can't force them to sell their house, and by the same token, you can't go in and rip out the cabinetry. So really, are there other options? You just have to wait until that house is sold before you can see any money?
Well, essentially the house isn't going to sell because it does have an encumbrance against it. So any buyer is going to do their due diligence, and they're not going to buy a property with a lien against it.
No, my question is, can you get the money prior to that house being, can the creditor get his money out? In other words, you got $30,000 in. Can you get your money, or just wait till they sell their house and then have the lien released upon the sale?
You can really force the sale of the house. I mean, the statutes from state to state generally involve 3 steps. The first step is some sort of a notification that goes to the owner that you've contributed to the improvement to let them know that you're out there, and they'll then make sure you get paid, hopefully. But if you haven't been paid, then you actually file the lien. And then the statute gives you another time frame and says, you know what, you have 1 year from the filing of the lien or something along those lines to sue to force foreclosure. And if the lien doesn't generate payment, then you are going to go to court and sue against the lien. And if you do win, then they're going to have to sell the property and pay you out of the proceeds. So that's kind of why the date maintenance is important too. These time frames from state to state of what you have to do and when you have to do it can really be somewhat complicating. If you're in one state, you can normally figure out what you have to do and be proficient in it. Once you get to 3 or 4 or 5, boy, it really gets difficult to try and translate. All right, and if you've read through these mechanics lien statutes, they're fantastic. They're better than Ambien if you're having trouble sleeping. So it can be a little complicated. But on the construction side, construction credit is just very different. We work with almost every industry in security through UCCs or mechanics liens, and the construction industry, I think, is the hardest credit environment there is. It's the most precarious. There's more risk. There's just more people involved, for one. In a normal business-to-business transaction, I'm going to sell to my customer. They're going to pay me in 35 or 45 days. There's just two parties involved with the transaction. In construction, it's completely different. If I'm providing materials to a subcontractor who is doing work for a general contractor who is working for an owner, all of those parties are going to touch my payment. The generals normally don't pay anybody until they get money from the owner. The subs normally don't pay any money until they get money from the general. So now there's not only is my sub involved, I have to look to the general contractor. I have to look to the assets of the owner to make sure that they're out there and they're okay. And really, that's kind of why the mechanics lien process was created. One of the other issues in the construction industry is you are asked to extend very large credit lines and credit sales to people that you may deal with one time in your life. Or they may not have the assets really that you would like to justify the credit line. You might have to set a credit line or sell on credit to somebody an order that's 5 to 10 times their net worth. In any normal credit decision-making process, your conclusion would be no, they just don't merit it. Unfortunately, the construction industry is built on credit managers finding ways to say yes in those scenarios. Now, again, that's why the lien process was created, to give credit managers in those scenarios some sort of an asset that they can pull in to make them feel better, like this piece of property that they've improved, or the trust fund of monies that's been set up for this improvement, or a performance and payment bond that's been put in place for their protection. So that's part of the factoring. When you're looking, again, construction is so different. If I'm a material supplier to a sub, I'm going to invoice the subcontractor. He's going to invoice the general contractor who's going to invoice the owner. That's a chain of payment, and it's only as strong as its weakest link. I may be selling to a sub that I've dealt with for years. I'm perfectly comfortable with the sub. Their credit rating is quad A. They're tremendous. But that sub is selling to a general, and the general contractor's on 10 jobs, and of the 10 jobs, the bank has just pulled the financing on 2 of them. It's unrealistic to think that that's not going to become a problem for me at some point in time. So there's a lot more factors involved with the construction industry. And again, that's why this lien process is created. Now,
another question for you. If you have the way the economy is today, what happens with the housing market over the past, I guess 3 or 4 years now, where so many houses are underwater. What happens to a property that's underwater, a house that's underwater with a mechanics lien on it? In the eventuality the bank decides, the bank take precedence over the mechanics lien? If the bank decides to sell it to get out from under, do they still have to honor that lien?
No, typically, a mortgage is going to be senior to a mechanics lien. I mean, just purely based on timing. So it all depends. Now, normally when a project starts up and somebody's going to build a building, there is a trust fund of monies that's set up specifically for that improvement, and that's really what we're concerned with. And when we look in different states, the amount we can lien can be limited to what's unpaid in that trust fund, and in some states we're leaning that trust fund more than the property. But it could be, in some cases, yeah, if we're filing a lien, it could be subject to that. If this place gets sold, how many liens are against it, how many mortgages are against it, and what's the equity in the property, and can we realize anything?
Well, that was the point. If the equity is not in the property, and if the bank takes ownership of that property, subsequently sells that home, does that lien go away, or does any of that lien get paid, or does it just go away based on circumstance?
It's based on circumstance. I mean, in a simple example of several of us have a lien against a property, and the bank has a mortgage against the property also, and it all goes bad, and they decide to force the sale of this thing, then the bank's going to get paid first. typically the priority of mechanics liens are all the same. Now, states vary them a little bit, but normally the bank's mortgage would be senior. If 3 or 4 of us have filed a mechanics lien, the priority of mechanics lien is usually the same day. Most of the states use what's called the first spade rule, meaning if you started work in January and I started work in February and Phil started work in March, and we all had to file liens, the effective date of all of our liens is the first day that somebody stuck a shovel in the ground and started this project. So we all would have the same priority behind the bank, and we would split basically pro rata anything left once the property is sold.
So point in fact being that those liens can go away. You know, once the bank takes title, if they sell it to a secondary buyer, they take title, someone else comes in and buys a $300,000 house for $100,000, and the bank says yes, the liens are no longer valid. They no longer stay with that property. Is that correct?
Well, the lien's going to be there until we remove it. I mean, it gets filed at the county recorder's office. We can leave it sit there. It doesn't mean that the owner is not going to say, wait a minute, this isn't fraudulent, this is a frivolous lien, this has all gone away, you need to remove it, and then we would have some liability. So we would want to remove it, but I mean, pending, it's our choice. If we file the lien, we're going to have to remove that lien. So at some point in time, we're going to have to make an agreement of what we're going to get paid and remove the lien or not, or we just leave it sit out there.
Even if the bank takes title to that property, because it's really their property based on the mortgage. So if the bank takes title to that house, is your lien still? Can you put that lien? Does that lien stay in effect against the new property owner? Somebody comes in and buys that house from the bank. Is that lien still in place?
Yes.
Then the bank has to disclose to the new buyer that there's a lien on that property, correct?
I don't know if the bank has to disclose. Normally, buyer beware, the buyer was going to have a lender or they're going to have a title search done to go search that property. And when they do the title search, the lien would show up. I don't know that the bank has a responsibility to let them know. I think more it's buyer beware, and the buyer would have to find that out.
Okay, so in the title search it comes up as a lien. Then whose obligation would it be? The new buyer's obligation to satisfy that lien prior to, and they can negotiate the price down with the mortgage holder at that point. Am I correct in saying that?
Well, yeah. I mean, every transaction is different, so it would be a negotiation where I'm going to buy. I see there's a lien out there. Do I still want to buy I have every right to back out of the transaction. This is the condition that's not precedent when we made the arrangement. So, or am I going to tell you, you know what, I'll buy it, but I am going to discount the price. I'm not going to pay you as much. I'm going to discount the lien. Or you pay it, have it removed, and then we're back to the original deal. So, I mean, everything's a negotiation. Every deal is going to be set in its own way. But you would think that the buyer would somehow acknowledge that and say, we have to resolve this one way or another. I'm just not going to buy the property with this lien against it.
Right. Really what my point would be is that regardless of whether that property goes underwater or
not. Would you like to hear more? This is Phil Philbin, the radio talk show host on Business Credit Radio. This full version is available at www.blogtalkradio.com, or you can go to our website at ccma-llc.com. I'm Phil Philbin for Business Credit Radio, and we'll leave the phone lines open for you.